2017 should be a slight reversal of the previous year. Last year we saw a downturn in activity, in exchange rates, in investor interest, and in corporate performance as well. We saw a tiny growth a spike in inflation that has unfortunately continued even into this first quarter of 2017. Where we headed, on the macro level, we need to get a grip of our exchange rate, and we need to instill more confidence that that rate is not going to continue to deteriorate. And it's critical for us to do that because that's going to determine a lot of investment activity for this year, and it's going to affect I think everyone's expectation for this year. If we can halt the slide in foreign exchange, and we can talk about the various things that would help us in halting it. One of them is import substitution. Another one is developing our export market and broadening the expanse of the expanse of what we're exporting. So, of course, we all know that oil is not exactly going to be a major, even if it does return to being a major driver. This has shown us, this period has shown us the risks of the risk we go through if we are a monoproduct economy, especially one that's a commodity. So we don't have even any control over it. It's done by world prices. So if we can find a way of supporting import substitution, that saves us some foreign exchange, that puts us in a stronger balance of payments position, and that improves our exchange rate. If we find a product that we can export profitably, that has a lot of local input, that's got some value add in it, it obviously it just enriches us, empowers us more financially as a nation. If we can do those two things, then a couple of other things will follow. One is that we'll be encouraging local industry. By encouraging local industry, the multiplier effect on that means there's more employment, that means there's more spending power, that means that there's growth in the economy. It also means that, of course, you're encouraging an industry to grow as well. If you're encouraging an industry, that industry too is going to start demanding certain supplies. So it makes for a more robust economy if we can stimulate it. That growth, and there's a reason why I'm going about it this way, that kind of industry, for it to grow, it needs support, and that kind of industry, I think a lot of people have classified as the SME kind of industry. I mean, that's a very broad term, but really, local industry is critical and requires a lot of support. Our outlook and our focus on this year, therefore, would be a lot of supporting that kind of industry, supporting the SME space, trying to create avenues for private equity to find those kind of investment opportunities. We're close to creating a repository that would basically provide a database of all these kind of companies and information on them so that investors can come in and find them. So we're making it easy for investors to find such investments. Trade restriction is one we're hearing increasingly more and more about. Trade restrictions will not impact Nigeria significantly. It will impact the rest of the world, and it's something that Nigeria should probably start looking at very closely. If there are restrictions on trade, especially inflows into the United States, who's a relatively large consumer, those export markets are going to look for somewhere else to sell to. It is likely that they target Africa as a sell destination, and so we'll probably be seeing a lot more things being pumped at us at, buy one, get one free, and all sorts of promos, just to make sure that this part of the world starts consuming more and more of those products that cannot be shipped over into the United States anymore. That's something we should look at very closely, and something we should guard against very closely. Of course, we've had lots of discussions about being a dumping ground for products and so on. I think it's going to be a bit more pronounced this year, and we should be very, very watchful of it. I think that the US dollar is going to continue to strengthen. Again, that is going to, as that strengthens, obviously, ours is going to weaken. So unless we take very strong and defined steps towards improving the standing of our currency against other currencies, this slide may continue for a while, and everything else that goes with it. So we really must focus on it and very quickly address it. Interest rates worldwide, I think the United States again is going to probably not raise its interest rates significantly, but it still will attract a lot of capital coming into the United States for as much as it can. It will attract a lot, unless, of course, and this is it's something that we'll just watch. We don't know whether it is going to happen or not going to happen. Quite equally, currencies can flow out of the United States, especially if it's perceived as being either hostile towards a particular group or not in need of a particular type of funding. Funding can actually flow out of the United States, in which case it weakens. So it can be the reverse. It can be either way. It can be the reverse, where funds move out of the United States and into other parts of the world, such as Nigeria, in which case we may actually still get access to foreign capital. Every market is going to be affected by, fiscal policy and monetary policy. Fiscal policy, monetary policy to start with. If the government continues to draw monies out of the economy by managing its interest rates, by monetary tools, especially cash reserve ratios and interest rates, then it will continue to crowd out investment activity, primary investment activity in the form of IPOs, as well as secondary in the form of ordinary investors seeking investments. Remember, the government is probably the safest borrower in the country. They give you a risk-free rate of return and a tax advantage as well, and a tax shield as well. So that being the case, the return that the government pays sometimes is up to about 20% on some of its instruments. Really, unless your business is making 20% return with no risk whatsoever, you're better off giving your money to the government. So we think that monetary policy, for as long as the focus is on withdrawing cash from the system so that we don't fuel more inflation, and so that we reward, we make sure that we have a positive yield on investment, and that's the purpose of this. The purpose of the high interest regime that we have now is because we want to ensure that investors have a positive return on their investment. In other words, they generate a return that's higher than the rate of inflation. If they cannot generate a return that's higher than the rate of inflation, people will not save money. And if they don't save money, they'll continue pumping money into the system, then you have more inflation. That's the thinking. And so you reward people for not spending money by giving them a return, a positive yield, which is fine. We all should anticipate it. We all want a positive return on our investments. However, the problem is that approach is crowding out every other investment opportunity in the country. No other investment opportunity can compete with 18% to 19% that the government is providing on its risk-free instruments. So it's skewing the market, driving investment opportunities, driving investment funding away from the proper or the expected users of finance, which is the private sector. Just putting the money in the hands of the government, who is using it to probably finance its budget and so on. So that's one problem. Another problem that's almost directly linked to it from our point of view is that then the government has some kind of financing and it uses it to implement its spending. It uses it to cover its spending. We run one of the highest budget deficits to GDP ratios in the world, basically, and we're behind many countries. So I think something that we need to look at. We have a very small rights that we're doing. It's 190 million naira. Essentially, it's just to basically increase the size to make sure that we are above the minimum capitalization of the SEC. That's what this first tranche is. We think that it will go to the market in early March, preferably in the first week of March. before the end of the first quarter. We should go to the market. It's a rights. It has been approved in the ratio of 1 for every 3 shares that have been held, and the market price I will not disclose yet because we're still, we're still in the Securities and Exchange Commission trying to get our approvals. But it's at a fair price for our operations to date. And essentially, as I said, it's essentially to show up our share capital and to use to expand some parts of the business. I've spoken of some new lines, private equity and so on. We're building platforms and capacity to go into those areas. Our belief is that there is demand. Our belief is that there is a lot of opportunity. This is probably a very good time for people to reinvest in certain areas. For example, this is probably one of the best times to buy a property because they are at rock bottom right now. So, there are a couple of opportunities that come that will not come when the economy is buoyant and running full-fledged. This is a build period, and we think that for a lot of entrepreneurs, this is probably the time when they need to do the grunt work of building so that when there is a full turnaround of the economy, they're actually in position and they're not left behind trying to start a business when they actually should have been running.